Well, if you just look at the market, 71 points higher as far as Nifty is concerned. Markets are looking positive. Earlier in the day, we did hit the 11,000 mark, and that, of course, is something which the bulls have cheered. But all across the space, results is something which is in focus. What's happening with fundraising across financials is in focus, and one such company which is reacting to both the news of fundraising and results today is M&M Financial, 9% higher for that name. Ramesh Iyer, VC and MD at M&M Finances, is now with us. Mr. Ramesh, thank you so much for taking our time for us. Could you just start by the numbers first? PAT was slightly lower than street expectation, maybe due to higher provisioning or credit cost. Will you take higher provisioning in the coming quarters as well? Share with us what is the profit growth that you foresee for the upcoming quarters.
So, these are very, very unprecedented times where one cannot really plan for, what next. So we have to be extremely flexible in terms of what happens at the marketplace, and then you take suitable decision. So if you look at the fourth quarter gone by and the first quarter of this year, we took a higher provision because the moratorium was continuing, and the customers did take moratorium, and we had to ensure that as moratorium ends, we have taken a view on certain segments of customers who would find it difficult to immediately start repaying. And if I had to give an example, take the heavy commercial vehicle. I don't think in a hurry it's going to restart earnings for them, and therefore they may take a little longer. So we took a view that let's cover for a higher provision for going forward. As far as your question on will we continue to take these kind of a stance in terms of higher provision, the ECL model per se requires us to cover only 30%. We have taken a view that the delay of repossessions or delay in repayment could have some impact on the collateral value, and we have moved our ECL, if you look at it, from 30 to 40, and the coverage has gone to 40% already. So for the current NPA numbers, we may not require to possibly take another additional coverage or additional provision, but surely we will have this view and take a very close look at on a month-to-month, quarter-to-quarter basis. And if there is a requirement to do so, we would not hesitate.
What percentage of AUM is still under moratorium? Give us, given the cash flows for farmers have improved, do you witness a good improvement in the collections as well?
Yes. So if you look at April, we just, total lockdown all across the country. All branches were shut, but we still had about 500 crores of collection. That moved to 1,000 crore in May, and that moved upward of 2,200 crores in June. So clearly, we have witnessed month-on-month doubling of collection in that market. Now, when it comes to the moratorium, you're right, 75% plus of the customers originally had taken moratorium. But very interestingly, 40% of those customers have actually repaid installment during this quarter. So somewhere it appears that the consumers did not also know whether to take or not to take moratorium, first of all. Second is, did they initially understand what this moratorium is all about? So I think these were the two confusions in their mind. We reached out to 15 lakh customers, and then we explained to them about what this moratorium is all about. While they took moratorium for their own precaution, but 40% of them have repaid. As we speak about July, we continue to see buoyancy in the rural cash flow. I think the harvest has been phenomenal. The yields have been good, support price has been good, and even the buying has been on time. So I would very strongly believe that the rural turnaround and the sentiments turning positive is at the back of phenomenal farm cash flow. And given that the monsoon is definitely expected to end above average, given that started on time, widespread sowing percentages are very high, I'm very, very confident that the farm cash flows will also hold up. And therefore, post-October, one can see better buoyancy from the rural.
Okay. Mr. Iyer, you also expect faster than, expected recovery in the rural sector, you and many others. Which are the segments that are showing signs of revival, higher growth, and also how has credit demand been over there?
So again, similar to collections, April, absolutely no sale. So therefore, obviously, there was no credit. May did see some volume, but June, we did 30,000 vehicles. And if the products were available sufficiently, the numbers could have been much higher. So the real constraint today, I would believe, to start with, is the ability of OEMs to make products available to dealers. And that has been, their supply side possibly has been impacted, and that's delayed the vehicle availability and tractors availability for across the country for various dealers. So the footfall of consumers, both at the branch level and dealership levels, have definitely gone up. And we do see traction improving there. The only segment that I have a little concern could take much longer is going to be possibly heavy commercial vehicle. And that could take a little longer. As otherwise, you look at tractors, you look at small cars, you look at pickup vehicles, you look at small commercial LCVs, you look at pre-owned vehicle. I think all of these segments are definitely showing positive traction, and the consumer demand definitely is there. Yes, what we need to do to convert the demand into credit for us is possibly relook at designing of some of our offerings and products to consumers. And if that was to happen, I repeat myself, I think one would see a good festival season and march towards improvement as we close the year.
Share with us, the kind of asset quality trends that you're observing. The expectation is that NPAs will spike over the next couple of months. From the customers that have opted for moratorium, how much do you expect could translate into non-performing or bad assets?
I don't know why is people wanting to look at a spike in NPA. At least for the retail, that's not my belief. I mean, you look at it, most of these customers who have been given a moratorium are people who have been regularly repaying installments to. I don't think we have given moratorium to already a high delinquent customer or an NPA customer. So the consumers who have been considered for moratorium are people with zero outstanding or one installment outstanding, two installment outstanding. And if you look at the history of this customer who would have borrowed 2 years back, 1 year back, if somebody has repaid 18 months, 20 months, 22 months, 15 months, I'm not sure why do they want to default unless their entire business collapses. Now look at what kind of business are these consumers in. These consumers are on a routine, daily, need-based operations, right? They are into people carrier from a point to point. They are into small goods transportation. They are into essentials like vegetable fruits transportation. They are small traders at the local level who are important and required, right? They are subcontractors who are doing local jobs. So all of them, as they start to earn, definitely they will start to repay, right? That's why I said 40% of the customers take on moratorium are already repaying. So I don't think there is going to be a spike. Yes, do we expect all customers after moratorium to start repaying immediately on a month-to-month basis? Surely not. There is going to be some delay. Some of the consumers may not be able to pay the full installment, but they'll surely discharge part installment to start with before their earnings can get full. My personal opinion is there will not be a spike in NPA, while there will be a bunch of overdues happening. And as the market opens up, even the overdues would get sorted out. There are certain segments where there could be increase in an NPA, or certain geographies it could happen, but definitely not across portfolio. And as I said, the products that where we see it could possibly go up would be heavy commercial vehicle, would be taxi aggregators or taxi operators, because they are all attached to tourism or they are attached to hotels and things like that. So there could be some delay from their side, and that could lead to some NPA for some of these consumers. But these are all collateral-backed lending where the assets can be repossessed or the customer can even surrender their assets for settlement. So I don't think a spike of NPA is the right approach. Definitely increase in overdues will be there, which will get sorted.
You mentioned that pre-owned vehicles are showing better traction and could be a turnaround story. However, we have seen that its share has dropped quite significantly to just 3% of value assets for financed, while tractors have seen good growth. What would you say about the product mix?
I think one more quarter you would possibly see tractors doing better than any other product. But as the festival season comes in, you would start seeing the distribution becoming almost similar to what we had. Definitely heavy commercial vehicle disbursements would be much lower because the demand itself is so low and the product sales are not high. As far as pre-owned vehicles are concerned, again, the demand is definitely there. Unfortunately, supply side is weak, right? Nobody is selling off their vehicle at this stage, or exchange programs have still not started because the RTO transfers and registrations will take time. So all of this we'll have to wait and see. Post-September is what my feeling is, that things will start to look better. As we close the year, we don't see substantial change in our product mix. Yes, definitely there will be dip in the heavy commercial vehicle disbursement. There will be dip in our SME disbursements. But on an otherwise product combination basis, we would still think that tractors, UVs, cars, pre-owned vehicle, construction equipments are showing decent traction. I think all of this would be the real volume drivers for us.
Credit cost remained elevated in Q1 despite liquidity improving in the system. Share with us the credit cost that you expect through the year. Any guidance on that front?
See, this has been discussed many times. For us, the first and second quarter from the rural perspective is never a big quarter, right? But fortunate this time that the crop monies come on time, and you have seen substantially subdued level of increase in NPA in the first quarter, and we have taken an aggressive stance as far as additional provisioning is concerned. So if you're already at a net NPA level lower than what was March, and as I keep repeating myself to say that post-October, we would see substantial improvement to cash flow. Just look at a situation where, the monsoon this year is going to be again good. Therefore, the harvest between November, January would see a good yield and a good farm cash flow coming in. That should definitely help in terms of overall collection improving and controlling the delinquency going forward. I also believe it's so much of rural focus that the infra activity that should commence to happen post-October, whether on the road fronts, whether it's on the mining, whether it's on the coal auctions, etc., etc. And when both the cash flows, that is farm and infra cash flow, check around well in rural, I think rural buoyancy can be witnessed and rural will be a turnaround story.